There are hundreds of formulas across the CFA charter, and that's pretty scary. And the big question is, how do you actually remember them and apply them under exam pressure? The good news is there are proven ways to maximize retention so you can recall formulas at the click of a finger when it matters most. In this video, I'm going to share exactly how I did it and how these strategies helped me get 90th percentile scores in the CFA exams. If you're new here, I'm Harris, an investment banker and CFA charter holder who studied at Imperial College London. So I'll start by giving you some general guiding principles, and then we'll step through a worked example from equity at level 2. Now, one of the biggest mistakes people make when it comes to CFA formulas is trying to memorize them. This simply does not work. There are far too many formulas, and as you step up from level 1 to level 2 and 3, it isn't as simple as recalling a formula and plugging in the numbers. You have to know which variation of the formula to use, as there's often different use cases, and you may have to calculate a variable before you can actually use the formula. Therefore, the first point is that you must focus on understanding the formula, not memorizing it. And to do this, derive the formula wherever possible, even if you don't need to know the derivation for the exam. If you're using either Mark Meldrum or IFT, they'll usually derive the more complex formulas, so I would note down this derivation in my notes. Now, in general, for every single topic, I would make my own set of formula notes or a cheat sheet away from the bulk of the main material, because the formulas get lost in there and you want to be able to focus on them in isolation. And when making these notes, and you'll see this applied later on in the video, here's how I would approach it. Firstly, write out the formula in red pen so it really stands out, and every time you see it, your eyes will be drawn to it, and this will build familiarity. Then define all the variables in a different color, so pick something like green or blue, and this will ensure you know what each of the variables mean, and again will add a second layer of where your eyes are attracted to. Now, if there's specific quirks or relationships related to a formula, I would also note those down. So let's look at an example, which is beta. So as you can see here, there are 3 permutations of the beta formula up on screen, and on the far left we can see beta equals the covariance between I and M over the variance of M. And you can see you can break this formula out further, and really the relationship in play here is the relationship between covariance and correlation. So you can see that covariance equals correlation times the standard deviation of I times the standard deviation of M. So I would make sure that I know that relationship, because if I know that, then I don't really need to know any of these other permutations. So when I'm making my notes, I would make that very clear, and then I don't have to learn parts 2 and 3 of this formula. And finally, particularly for the more complex formulas, I would always include a numerical worked example underneath it. And the reason is, as you can see from the beta formula we just had on screen, there's so many symbols and notations that are confusing to look at. So if you can attach numbers to these, it brings it to life and it makes it much clearer in your mind. Now, I take these examples from either the blue box examples in the curriculum or the IFT notes, etc., or from end of chapter questions where you've looked at the solution. Now, in terms of formula retention, here's a few key principles. Now, the first is that formulas only stick once you apply them. There is no way around this, and therefore practice is key. Now, don't panic. The first few questions that you'll do is very unlikely that you'll recall the right formula, but just try and recall all the possible options that it could be. Then read the question and have a go, and always make sure that you write out the formula every time you do a question. This will build familiarity and that mind muscle connection. So if you continuously write out a formula over time, it will just become second nature. Then try it and see if it works, and if it doesn't, revisit your notes and find the correct formula and do it again, and trace through the logic as to why it was that formula and not another one. And as I just said, if you're doing end of chapter questions and you think that this is quite a good example of how a formula is used, make a note of this example in your notes. Over time, you'll become much better at spotting the right formula and question combination. Another point here, mnemonics are very useful when you have formulas with multiple components. For example, when it comes to the components of interest rates in quant, I use the mnemonic RID-LM. This stands for risk-free, inflation, default, liquidity, and maturity. And I actually often struggle to remember these, but then I just remembered RID-LM. I'd write this out on the left, and then I can just fill in all the blanks. Now, another way you can improve retention is to build a list of formula names without the formula itself and use this to test yourself. For example, you might put 1-stage DDM, 2-stage DDM, free cash flow to the firm, free cash flow to equity, and so on. So you're just putting the name of the formula and not the formula itself. Although if you're building this list in something like Google Sheets, you could opt to include the formula on the right hand side or in its own column and then hide that column. But ultimately, you want to see the list of formula names and use them, and then just try and write them out from memory. Now, you'll be doing this a lot more as you approach the exam because now you really want to ensure that it's embedded in the memory. And in general, this employs active recall, which is crucial to cementing something to your memory. An important point here, don't just reread formulas passively because this will simply not work. You need to employ active recall and you need to apply them. And finally, the IFT formula and fact sheet is an amazing way of reviewing key themes and facts and formulas quickly. Now, if you don't have this, you can purchase this as part of various packages. The links to them are in the description alongside a coupon, which will get you 10% off. And you'll see an example of how I use it shortly, and honestly, it's a game changer. Real quick, if you're interested in passing the CFA and building a career in finance, I have something special for you. It's a short video where I break down the exact process I use to pass all 3 CFA exams first time and land my dream 6-figure job in investment banking, and how I help others do the same. In fact, we guarantee results. Pass your CFA exams first time and land a $100,000 plus role in finance, or we'll help you for free until you do. So hit the first link in the description and see if it's for you. In this video, I'm going to step through how I would approach making notes for formulas. Now, the example I'm going to use is one from level 2. We'll be looking at free cash flow to the firm and equity. And as you'll see in a second, there's lots of permutations of that formula, which can make it quite difficult to memorize them all. So if we step through them, derive them, and understand the logic behind them, it makes it much more easy to recall. Now, although the example I'm using is from level 2, this approach is applicable at all 3 levels. So don't worry, you can use this regardless of the formula you're faced with. Generally speaking, the focus is on making clear and concise notes, deriving where possible, as I said, and ensuring we add sufficient context. Ultimately, the objective is to get the logic clear in our mind so we can recall the steps we take to get to the formula rather than having to memorize all the formulas, and this makes recall much easier. I would also include worked examples alongside those notes to bring the formula to life, and these can often be lifted from blue box examples within the curriculum or from end of chapter questions. Now, as you can see up on screen, I've got the level 2 fact sheet provided by IFT, so if you signed up for their premium package, you'll have access to this, and this is definitely super useful. You can use this to scan through the curriculum quickly and refresh yourself on the key themes, as well as have a look at all the formulas that are testable and required for the exam. This is particularly useful at the back end of your studies when it's more difficult to go through the entire curriculum, so you want a way of going through things quickly, and as I said, just refreshing the key themes. So I flick down to equity, which you can see on the right hand side, and you can see it starts with discounted dividend valuation. We're not going to be looking at that, but below that you can see free cash flow valuation right here, and you can see there's lots of permutations for free cash flow to the firm, or FCFF, and below that free cash flow to equity, which is FCFE. So if you look at this looks very overwhelming and it's difficult to memorize all of these, but if you step through the logic and make appropriate notes, it's much easier to recall, which is what we'll be looking at now. So on screen you can see the specific notes for that section, again from IFT, and you've got the contents page. If we skim through this, there's an introduction as to what free cash flow to the firm and free cash flow to equity actually is and when it's used. Below that we have the various valuation approaches, and we're not going to look at this. We're going to skim further down and look at how we compute free cash flow to the firm and free cash flow to equity. Now we start by computing free cash flow to the firm from net income, and you can see there's a number of steps, and that leads to this formula here. And then the rationale is below, which is super useful, and this is where I would particularly focus my attention. Now, I'm not going to go through all of this because I'll show you the notes that I've created to extract the most important themes. As we go down, you can see a worked example. I would always pay attention to these. These will bring it to life. And then we look at computing free cash flow to the firm from the cash flow statement. And here we'll be using cash flow from operations, or CFO. Again, the formula is below it. We'll come back to this. And there's a few notes on the different accounting standards, and then another worked example. A couple of additional considerations, and as we go further down, we move on to free cash flow to equity, and this is from free cash flow to the firm. Again, a couple of permutations. We'll be doing it from both net income and from CFO. Now, we do go on to also calculate it from EBIT or EBITDA. I have not included that in my notes to keep it concise, but now let's flick over to my handwritten notes, which I've scanned in. Now, off the top, I would always recommend you make these notes by hand for demonstration purposes. I've scanned them in so you can see the types of notes I would make. Then we start by outlining a few key points, which is always worth doing for formulas so you know when they're used and if there's important variables that you should pay attention to. So I started by defining what free cash flow to the firm and equity actually are. So free cash flow to the firm is cash flow available to all capital providers. So you can see here I put D plus E for debt plus equity. And then you have free cash flow to equity, which is cash flow available to common shareholders only. So this is equity only. That's going to be quite an important point. We'll come back to that. And then collectively, they're used when a company does not pay dividends or or when it pays dividends, but this varies from its capacity to pay dividends or when free cash flow aligns with profitability. It's then worth calling out when free cash flow to the firm is preferred to free cash flow to equity, and that tends to be when free cash flow to equity is negative, and this kind of looks like positive, but I've sort of drawn a line through it, and also if a company has a change in capital structure. The final point to call out is the difference in discount rate use. So for free cash flow to the firm, we use WACC, or weighted average cost of capital, and for free cash flow to equity, we use the cost of equity. Now, as you can see, that's a lot more condensed than the full preamble that we had in the IFT notes, and this is what I mean by not just simply replicating the notes. I pull out the very key themes that are going to help me understand and recall, and then we move on to trying to derive the formulas. So as we said, we start with computing free cash flow to the firm from net income, and immediately you can see that I've written the formula in red. This always helped me immediately spot the formula, and then I would add context around it in different colors. Now scanning it in has kind of negated the blue, but these markups were actually in blue. This one and this P&L items and cash flow items was in blue. The rest of the writing was in black, and then I've added some further annotation in green here. It's totally up to you what colors you use, but this helped me quickly identify the different things that I was looking at. So free cash flow to the firm equals net income, or NI, plus NCC, which is non-cash charges, plus interest times 1 minus tax rate, minus fixed capital investment, minus working capital investment. So there's quite a lot of components there. Let's break this down further. So the first thing to call out is this is free cash flow to the firm. So everything here, all the adjustments we're making to net income are adjusting for cash. So the first thing we do is add back non-cash charges, which makes sense. These are only accounting items. These are not impacting the cash of the company. So an example of that would be depreciation and amortization. Then we also add back interest 1 minus tax rate. Now, a couple of things here. One, we're calculating free cash flow to the firm. So this is before any debt or equity related costs. Since interest is a debt cost, we're adding it back. So here I've called out that logic. And because interest is paid before tax is paid, it also has an associated tax shield, hence we do the 1 minus the tax rate. Now all of these are P&L items, and then at the end we have these cash flow items. Now, as we'll see in a second, the first item here is fixed capital investment, or CapEx, which I've written here, and the second one is working capital investment. So these two are cash flow items. Working capital investment actually reflects in cash flow from operations, or CFO. We'll see that again. And fixed capital investment, i.e. CapEx, reflects further down in investment cash flows. Okay, so we've assembled that. Now, the first one is a given. We kind of just have to recall this, but make sure we have the logic down. But as we now move to the various permutations, we'll see that if we understand the logic, we don't have to memorize them all. So let's look at how we compute free cash flow to the firm from CFO. And immediately I've left myself a note to say net income is a P&L item and required adjustments for non-cash items, which we saw here. CFO already accounts for this, but also includes working capital flows. Hence, if we know that CFO equals net income plus NCC, or non-cash charges, minus working capital investment, all we do is simply sub it in to this formula here, and then we know how to calculate free cash flow to the firm from CFO. So as we can see here, we can replace this net income item, this NCC item, and this working capital investment item with just CFO. So the only things outstanding in this formula were interest 1 minus tax rate, which we continue to add back as we did before, and fixed capital investment, which, as I said, reflects further down the cash flow in investment cash flows. So really, if we're trying to recall this, we only need to remember this first formula, and we should know the relationship between CFO and net income. Now, as we go further down, we'll look at how to compute free cash flow to equity from free cash flow to the firm. Now, recalling the first thing we identified in the notes, free cash flow to the firm was cash available to all capital providers, whereas free cash flow to equity is cash available to equity shareholders only. So we do need to account now for debt-related cash movements, and that is essentially interest and net borrowings. So again, the formula is here in red, and we can see that free cash flow to equity equals free cash flow to the firm minus interest 1 minus tax rate, and again we've included the tax shield, plus net borrowings. Now, subtracting this first part makes sense. As we said, cash flow available to equity shareholders will be after we've paid interest, but also we need to include net borrowings. Now it's worth calling out why this is a positive sign. If we borrow money, i.e. we raise more debt, we will have more cash available to equity holders, versus if we repay debt, we will have less cash available to equity shareholders. So net borrowings can be a positive if we've increased the borrowing, and hence this is plus, and free cash flow to equity will increase. Whereas if net borrowings are negative, i.e. we have repaid debt, then plus minus becomes minus, and then free cash flow to equity will reduce. Now, if we are faced with net income or CFO, we can simply recall what we just did for free cash flow to the firm and substitute it in. So if we're now calculating free cash flow to equity from net income, we start by outlining what free cash flow to the firm was from net income, and recall it was NI plus NCC plus interest 1 minus tax rate minus fixed capital investment minus working capital investment. Now, since we identified above that free cash flow to equity is free cash flow to the firm minus interest 1 minus tax rate plus net borrowings, we can restate that here and then start substituting in. Now, I could have included an additional line with all the line items, but free cash flow to the firm here, which I've crossed out, is essentially what we have above. Since we are adding back interest 1 minus tax rate within that, but then we take it away again, we can cancel the interest line items out. And so we're left with net income plus NCC minus fixed capital investment minus working capital investment plus net borrowings. So it's really just rearranging formulas here. This is not difficult, but it does mean that I don't have to really remember free cash flow to equity. I don't need to remember this variation. I just need to remember this relationship up at the top. Similarly, if we're working from CFO, we restate the fact that free cash flow to the firm equals CFO plus interest 1 minus tax rate minus fixed capital investment. So again, if we recall the formula for free cash flow to equity, we're now just subbing in free cash flow to the firm, but this time assembled from CFO. And so what we'll be left with is CFO minus fixed capital investment plus net borrowings. Again, the interest terms cancel out. But you can see here we don't have working capital investment because that's included in CFO. So I sort of conclude this by saying, remember these key themes. Remember the net income and CFO relationship. Remember that free cash flow adds back interest 1 minus tax rate, whereas free cash flow to equity takes this away, and that free cash flow to equity considers net borrowings too. Now this is just an example as to how I would arrange my notes. You can see that I'm not adding a lot of superfluous or extra language. I'm not explaining every single thing. I'm just calling out the very key themes, and with the formulas specifically, I'm doing some derivation or some manipulation so that I understand how they are interconnected. So then I don't need to memorize all the formulas. I just remember the main core formulas, in this case for both free cash flow to the firm, which was this formula here, or number 1, and then free cash flow to equity, which is this formula here. Now, whether I'm faced with net income or CFO doesn't really matter. If I know the relationship between net income and CFO, I can just manipulate it and get to where I need to go.